Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to talk about using options as a hedge in bear markets. Now, the market's been very wild lately, Matt. Do you want to give us a brief summary of what's been going on, and then we can get into your experience as a trader and any advice you have for traders in this wild time?
Yeah, thanks, Tyler. It has been a crazy market, and many people that have only been trading the market for a few years, have never seen anything like this. So, I've been around for a long time. I'm going to date myself here, but I could remember, of course, the 2007, 2008 market, and 2002 wasn't that great. 87 was a very fast bear market crash and then come back. And I can remember all the way back to 74 going on a surf trip. I was a very young kid. I remember my dad getting really angry at the initiation of wage and price controls, Tyler. So
Wow.
that's how far back I can remember.
Yeah, that's
But
interesting. I
yeah,
I I don't think I was even. Yeah, I mean, I can't even remember 2008. I was definitely too young to trade at that time. So.
yeah. So anyway, when you go through that many cycles, and my grandfather was 99 when he passed away, and I used to talk with him quite a bit, and he remembers almost everything. He traded almost till the day he passed. So and he would always say, because I like to trade, and he would just he was a complete buy and hold, and he had this S&P booklet. It was a blue book that everyone used to read that talked about, had all the numbers in it, and he would ask me, "What do you think of GM?" or something like that, and then he would go. I would talk to him about certain stocks, and he'd kind of laugh and look at him. He said, "That doesn't look very good," or whatever, and then he would say, it's best just to buy some stocks and look at it once a year. And if you need to rebalance, you could rebalance. So there are, yeah, he's definitely buy and hold, but I'm definitely a trader. Obviously, I was a floor trader and backed people on the SIBO floor. So that was extremely stressful. And we saw some pretty crazy market. That was 2000. So that 2000 kind of tech crash was something. So anyway, those are some history points that I've been through, and you just got to keep your head during these downtimes. But like we always talk about on the show, you never want to be short units, and what that means is you don't want to be like long a stock is a short unit to the downside. Short a stock is a short unit to the upside. Short a put is a short unit to the downside. Short a call is a short unit to the upside. So you never want to be short. You always want to, if you're short a call, you want to be long call somewhere else. If you're short a put, you want to be long a put somewhere else. And you could be short stock and short a put, but then you need to be that's a synthetic short call. So then you need to be long a call. So we always talk about that. Anything could happen in the markets. I mean, this market could be up. It's up almost 4% today. And this is a bear market rally. You'll see a lot of these. If you're underwater, as many people are, I always talk about selling into the, if you find yourself, very stressed out, and you were way too long when it was going down, you might want to lighten up on some of your longs as the market rallies, just to, even if it continues to go up. I always told my traders to hedge their happiness. And then they said, "What does that mean?" I said, "Well, what do you want the market to do right now?" They go, "Well, I want it to go up." I go, "Well, sell some. And then now what do you want to do? Well, I kind of want it to go up. Well, you haven't sold enough. What do you want to do? I don't care. That's kind of where you want to be, like,
Yeah, you want
so
to be in that indifferent range.
yeah, yeah, hedge your happiness. Now, what most people don't realize is that they're really long the market, even if they don't own a share of stock. Their jobs. You'd be surprised in a recession what happens, or when the market really gets killed. It really takes down a lot of things, including home prices, and it's harder to find a job. And so everyone's kind of long the market in some way. So the only thing that doesn't go down when the market goes down, you think you found these other hedges, gold, crypto. When things get really bad, people sell everything. The one thing that they can't sell are puts. So you have to have some type of puts. Is what I always preach. And even in a market environment like now, you could do some things, and we'll talk about those a little later, Tyler.
Yeah, you bring up a lot of really interesting things there, about where people's money go when it's gets really bad. Yeah, I mean, I think in general, even things like gold, people are just looking to pull their money out, right? People are nervous. The VIX is climbing rapidly. Um, so yeah, and you mentioned the bear market rally that's going on. Have you seen that happen pretty much every time there's been a downturn, a bear market downturn in your experience?
Yeah, I mean, this is very typical, and it could just rip up and go all the way up, and that would be fine. I'm just saying, own some puts, and it allows you to buy some more. I bought some shares and some stocks that I wanted to when it was down there. I've been waiting for these prices, some overreaction, and then but I have long puts. I'm a permanent portfolio guy, as we've talked about before. The permanent portfolio is a quarter into cash, quarter into bonds, quarter into stocks, and quarter into gold. So it usually does well, even during the market duress that we're seeing now. But yeah, I mean, anything could happen. So it could rally all the way back, but you want to, again, just do you find yourself just hoping against hope that it goes up? You might want to lighten up. And I'll show you one of my favorite ways, and one of the things that I've been using, to do really well in this correction. I think you should try to do really well in these corrections, and just kind of do decently. Like, I trail the market when it goes up. I'm perfectly happy with that. But like even ORATS will do better if there's not a recession. So so everything, I have a house and I have all this stuff. Now I'm in Spain, and I just bought a guitar. So everything's going to go down in value if there's a big recession and the market crash. So you want to protect yourself. So even now, it's not too late. People ask in some of my comments, is it too late to buy puts? And that was back when it was, the market was like 5,500, and now it's 5,200 after a huge rally. So never too late. You should always just have some protection. There are different ways to do it. In certain volatility environments, like now, I don't know if you can see my screen right now, but there's very high volatilities in the front months, and it kind of goes down. There's no free lunch, though. I mean, because what's going to happen if the volatility comes down? It's going to go down in everything, and if it goes down in the out months, the Vega, which measures how much the price of your options will change if the volatility goes down. Those 1%, so those will go down faster. So it's not like you should be necessarily selling the front month and buying the back months, because you got to really watch that. So I'm more now into put spreads, and especially now with the really high volatility, you could buy these put spreads, and we'll look at them a little bit. That if the market closes right here, you'll make money. And even if it goes up a little bit, you'll make money with a put spread. So I want to show you those in a second. But anyway, and we've talked about put calendars. I'm a little leery about put calendars right now, just because with the calendar, you're buying the out month. You're buying something like, I like to do, like a year, 400 days on the long, and sell the 100-day. So, I'm just a little bit leery about that because, the volatility's gone up in every month. And when it goes down, they're gonna take down the vol, even though you think you have some protection, but it really is long Vega. So you got to watch those types of trades now. So I'm not really doing those, and I'm not really buying or I'm not buying long puts. I'm doing spreads, and like I said, we'll show you some that look pretty good to me. Maybe we'll put one on for next week, Tyler.
Yeah, one thing I like about your stance on all this and your opinions on all this is that you've been very consistent. I think viewers can go back through previous shows and see that you've been saying the same things. Like it's easy to say during this downturn that it's go and buy puts, right? But you've been saying that for since episode 1. So I think I definitely appreciate your consistency on it, and it bleeds into ORATS a lot. I mean, we're known for not offering a short strangle back test because of your very opinion about this matter. So I like how consistent you are about it, and it definitely reflects in the platform too. So hopefully today we get a chance to show some features that are sort of in line with this belief system of always having puts on and being very risk conscious in order to not be in such a bad position in markets like this.
And I should say that John has talked me into to putting in the short strangle. So you'll see a short strangle in there, but I think we should have some disclaimer.
What is the strategy we don't have then? I thought we didn't have something in there.
Yeah, no, we don't have a short strangle.
Oh, okay.
He's talked me into it. So we're actually putting in our next release in the backtest finder. We are putting in the short strangle.
All right.
Yeah, so you're going to see it there. Yeah, so like I said, I'm in Spain. Apologize, my laptop's exceedingly slow, and the market is, So let's talk about the market for a second. One of the strategies that people use, they use a stop loss. So let's talk about the stop loss in these types of market because that's interesting as well. And there's also some new rules. So a lot of these 0 DTE, 1 DTE type strategies are using stop losses to hedge their risk, really. So stop losses can work, but the market has to be open. If the market is closed, the stop loss is not going to do you much good. So that's the first point. You have overnight risk. Now, if you're just trading 0 DTEs, then it's not as bad, so to speak. So if you're, but still, today there's some huge gaps. Like the market's up almost 4%, and you're going to see markets just. I was a market maker. It's almost impossible to keep up. I mean, the technology can't even keep up. So, and it has to then be communicated out to brokers, and there's just a massive amount of trading going on. So it's really hard for some markets to keep up. So you have to be very careful about the stop losses, and the SIBO has instituted some protections, but even some of the traders are worried that the protections are going to work against them. Like when they want to get out at any, sometimes you just want to get out at any price, there's wide market protection. Well, that takes some time, and the market could just be falling and they want to be selling, and you might not be able to. So you definitely want to know the rules if you're starting to do these types of strategies that involve short selling. So that's one thing I want to talk about. So right now, like what I want to do is like I want to get like let's just say I had some problems and lost some money when the market went down. Now it's up, so I've made some money back, but I don't want to have that happen again. So I want to talk about a strategy that I think is pretty good, that can get you some, short deltas, meaning you make money if the market goes down, and it's kind of an interesting trade. So if you look at the 530 put, so I like to trade something in the money, and then I like to sell something a little out of the money. So the 530 puts are $15, and the 520 puts, I would sell those for like 11.50. So that is half in the money and half out of the money. So that spread, right, is right around the money, and it's 1570 minus 1150 is 420-ish, about 4 right now.
You're
So
trying to make that break-even point right, kind of where the price is right now.
well, what I'm going to present is that even though this is like, if the market were to expire right where we are right now, this trade would make $5, right?
Yeah.
And we're in the money, and we're only paying $4 for it. So this is a type of trade that I like to do when I I want to get some short deltas. Does that make sense?
Gotcha. Yeah, and yeah. So this is the type of trade you do when you just feel like you're a little stretched too much on the long delta side of the stocks you're trading. So does it have to do with your? It looks like on the payoff diagram your risk is capped on the downside. Is that part of why you like this trade?
Well, yeah, you could only lose $4, and you could make $6 because it's 10 wide. So
it's that's pretty much the only variable you're adjusting then, and that's why I like it, because you're very much flat on either side, but you're just a little bit more profitable on the downside.
Yeah, I mean the payoff diagram, it's kind of a binary thing. Like I'm like the market is just ripping up, ripping down, and so I think it's kind of like a coin flip, but a coin flip would be $5, and I'm only paying 4. So that's the way I think about it. Like it's kind of right at the money. Like again, if it closed right now, the market's going down a little bit. It's 523, so we'd actually, it'd be like $6 and change that we would do it for. So I'm going to put this on.
Could you adjust this to be slightly more weighted to the downside if you just needed a lot of more protection?
Yeah, you could definitely widen it out, but I did a SPX 50 wide, so and paid like $20 for it, and then I paid $18 for it, and then it went right way in the money, and then it went out of the money. So, so these are the types of trades that I like to do, again, because you can't really do a calendar because the volatility is so high, and you can't buy a put because that's still really high. That's really risky, but this, I figure I'm betting 400 and I can make 600. That's how I think about it. And
I'm surprised I'm a bit surprised you don't like the calendars in this environment, because it seems like very high short-term volatility and relatively low long-term volatility.
But the problem is that if the Vega is so different between the front month and the back month, that it's a long Vega trade. Even though the volatility will go down faster in the front, you still got to really watch out for the Vega and the out months.
So even though the term structure looks like a good calendar trade, because we're in contango, right?
We're in backwardation. Contango, we're in negative contango, as ORATS calls it, but this is a weird name. It's rare, but backwardation is when the front month's above the back months.
Yeah, so I had kind of always thought that in backwardation it's good to sell the calendars, or to sell the front month and buy the back month.
Yeah, that's normally true. However, you really have to look at the levels. Like, so these levels are really high. So, like these are up in the 20s, and they're usually down here. Like, so they're in the 15. So those are going to come down a lot. And so I mean, we could look at one of those. Actually, we could
So
probably do it
yeah,
right in.
this is a good opportunity for a scan or just a take a look at the ORATS indicator. So for a good calendar setup environment, you really want the market to be in backwardation, so a low contango or a falling contango. But you also want, I mean, how do you quantify this other metric that you're talking about here? This sort of increasing vega.
Yeah, so I mean, we could look at it in a payout picture.
Like, is there a
And
way to scan for this, like combining the backwardation with this other thing you're talking about?
well, I mean, what we're seeing is high infinite volatility. So meaning, or 2-year, we
Oh,
say infinite. So so that's what we're seeing right now. We're seeing like that in the extreme. So let me just try to build this, build a
yeah.
trade
So
here.
ORATs, just to give the audience a clear idea of what the infinite volatility is, so ORATs has two different, um, or more than two, but we look at uh, a interpolated calendar day metrics for volatility, as well as slope and derivative and everything like that. So we also have an infinite, right? Which is it's the 2-year, right? But is it kind of, do we call it infinite because it's more than that?
Well, there's an asymptote that when we solve for and look at the entire volatility term structure, it's actually what's called an asymptote, which is an infinite number. But most people don't know what that means, or so it said, and it's very close to the 2-year.
Okay.
So we just say it's it's
It's as
approximately a
far
2-year.
out as you can go in the options chain, essentially.
Well, 2.78 years, yeah, and they're adding some longer ones, but yeah, essentially that's what we're doing.
Okay.
But again, you're true that there's when things come back to contango, that's the normal way markets look, then the front months will come down a lot more, but the vega is a lot less than the out months. So if you
Gotcha.
have high infinite vol or high 2-year vol, you're gonna, and that comes down, you have much more vega. So in those, so you're gonna lose a lot on your long, and you're gonna make some definitely on your short, but those, that calendar is, I think, a little bit dangerous in this market. I should also mention, when you have a calendar, which I have many of those on, I had a couple calendars go through the strike. So I had the 520s when the market was 6,000, right? And I'm go, so usually what happens is the market will come down towards your calendar, and you'd be happy because your front month expires and your back month goes up in value. But if it goes through, a calendar is more of a tent. So if it goes past the tent, then
Interesting.
you're, yeah. So then
Yeah.
you get, you sometimes have some issues there.
Calendars they're tricky.
They're definitely tricky. So let me see if I could change this around a little bit. So I'll move this out to an outer. Let's go out a bit, and then go out a bit on the. So to show you what I mean here. Oh, I think I clicked on a expiration that doesn't exist.
Oh no.
Yeah. Anyway, yeah, I'll have to reload this. We have to fix that little thing.
We should
Anyways,
disable the expirations that don't exist.
yeah. Um, Anyway, the expiration existed. I just had it on a strike that where the strike didn't exist in that expiration. So we should do this a different way. I was just being kind of lazy, so we could do it through the chain, or we could do it through the scanner. So I'll try it with the chain this time. But anyway, so what I'd like to talk about is, if we talked about these calendars for a long time, and if you had calendars on, which I did, you kind of have to manage them as the market comes down to you. I mean, they did great, but you have to be a little bit. You have to be. You have to be watching them. If they're because you want in a calendar, you want it to go to the strike. So I had some 520s, like I said, and the market went down to 480, so it went way down. And so in that case, I just go, well, now I'm a little bit long deltas. So it went past the tent, so I wanted to go back up to the tent. Does that make sense? So I had the 520s. It was 6,000. It went way down past it, and now it's coming up to the tent. So now I'm sitting pretty on those 520s.
You
Does
are.
that make sense?
Yeah. So we got a question from we got a comment from one of our viewers.
Okay.
And it's a good one. And I think we need to explain how this works a little better. So in the trade ideas tab, there are calendar trades popping up. It's a little bit contradictory to what you said about not being in a good environment for the calendars.
Right.
So they're wondering why that is.
Yeah. So we'll go check that out in a second. Could they just say what the calendar is, so I don't have to go look for it right now while I'm trying to?
Yeah, I just pulled it up. So there's the first one that pops up on the list is an IWM long call calendar.
And what are the is it if you click on it, is the strike? Is it a perfect calendar, or is it a calendar that's long or short deltas, or what?
Let's see. It is. I think it's long delta.
Okay. Let me look at that in a second. I want to just explain this real quick.
Yeah.
So here's Tyler. Here's a calendar that I set up at 500. SPY's at 523 right now. So you can see the tent. They call it a tent, but the tent is down at the long strike. So what happened is the market came down through the tent, and now it's going back. So I said, well, I'm not going to do anything. So I'm okay with being a little bit long right now. So I'm just letting it kind of move around in this area.
Right.
Because I started off way up here. So I'm, so the calendar is very profitable, even when it goes past it. So it goes past it, you're still in the green here. So I don't know if you could see that, but the break even is 445 on this one, so it's way down here. So that's so that you're still in a kind of the profitable area. So yeah, so the trade ideas again. The trade ideas are different than me talking. The trade ideas actually look at market environments that match the current environment. So you might say, well, Matt's saying don't trade calendars right now, and this is saying calendars. Well, there are some types of calendars that have been tested in this market environment. This is a very short-term market environment. And let's just kind of look at what that is.
We can view the backtest too to view the inputs on it, and yeah.
Right. But anyway, here's stock prices below the 50-day SMA, right? So that's fine. It wants to do a cheap kind of out of the money, looking for a bear market rally. I don't mind this trade. This is not what we were talking about before, right? So this is a call calendar. I was talking about put calendars about buying protection, and that's what we're kind of talking about right now. But this is actually a decent way, Tyler, to get long and to play these bear market rallies, right? So
yeah, I mean, it's a relatively short-term strategy. I
Yeah.
think the only thing I don't like about this strategy, Matt, yeah, as I see what you're saying, but the market just moves so fast now. It seems like it's moving faster than ever before. And, with the trade that's out, 2 to 3 weeks like this, is this something you're looking to close in the next few days or
Well,
a week maybe?
if you want to mimic the back test, right? So calendars, you usually, So anyway, I'll look at it in a second, but you know, even though the market's moving, but this gives you some long deltas though. If you
Mhm.
and it could, you're right, it could close anywhere, but and also let's see if this has any rules in it, um, exit rules. Calendars rarely have calendars rarely have exit rules that are stop losses because you don't pay that much. And this one, I like this one, Tyler, because it's saying when you make 100%, get out. So you just have it just has to go to $1.60. If it goes towards the tent, then you get out. And so if it's moving around a lot, you could
Yeah.
get you have a lot of what's called gamma. So even in this calendar, so I think we put this on and we set an alert.
Yeah. All right,
So
let's do it.
let's do
Thanks
this
to
one.
the viewer for helping us
Yeah.
find another trade here.
All right. So let's force it. So and then what will happen is we'll get a text message when if we get to profitability on this.
Mhm.
So we're filled there. So let's go down to IWM and pull it up. I could set that as a call. It will eventually do it, but it just takes a minute. But we'll add an alert. And then let's see, let's be lazy and restore from history. So we'll put in we'll delete the stop loss because you rarely do a stop loss on a calendar, and we'll set
Okay.
the profit and loss, and we'll say paper T hub, and so we'll get an alert if it goes up and that's profitable, and then we'll present it next week when we come back, Tyler.
All right. Thanks, Matt. Yeah, if we had more time, I wish we could go to the backtest finder and compare this against other long call calendars with different expirations and different profit targets and stop losses. But sadly, we are out of time. So
No, I like
um,
this. I like this
yeah,
one because like you said, there are bear market rallies. So if it does go up and down and up and down, all you needed to do is kind of go approach the tent pole, the middle, and
mhm.
likely you'll have the profit that you're looking for an exit. So I like it.
Cool. Yeah, I think it's a good trade. All
Yeah.
right. Well, thanks, Matt. Lots of good lessons here. I liked what you talked about in the beginning about hedging your happiness. It was kind of a theme throughout with all the puts that you're talking about, and like the back test we just viewed. It's not always black and white. You can have different strategies on expiring at different times. Some are long delta, some are short delta. So I think it's good to understand the differences between those, and um, always good to see the back tests and stuff like that. So. Thank you, Matt, for sharing your insights on this. Very interesting time in the market, and we'll be back again next week to see what happens. So, thank you for showing that, and thank you, Trader, for hosting us. We'll see you guys again next Tuesday.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.